All right. Well, I'd like to have ASL thank for having me come here. We've actually been partners for years. We've worked together on a variety of different things, and so they asked me if I could do a little something, and so you only have an hour. Any one of these topics could be a week-long course in the sales, but we're going to cover some things in this hour, and we're going to talk a little bit about market trends, kind of getting ready to, prepared to roll out the door as a company, and getting funded as a high level. And so what's going to be a little different, though, is we're going to talk about it a little bit more from a sort of real-world type perspective. So, I've been doing this for a long time. I started South Valley Angels about 5-6 years ago down in Morgan Hill. We're a small little group. We've done about $4.2 million in investment, as angels, and most of those are like 200,000 type stuff like that. I've worked up and down the peninsula, pretty much all the incubators and up and down, so I've been all over those stuff. So I've been doing this for quite a while. My first startup was 1998. The .com, that's a story in its own self. Let's see if I got this clicker right. All right, so let's get started. We'll try to get as much as we can, and please ask questions. I like to sort of gear what we're doing. I'm not up here to talk for an hour, so let's ask questions and move along. So we're going to talk about trends. So everybody talks about how important trends are, and trends are extremely important. But I also look at trends a lot like statistics. I can find any trend to validate what I'm doing, just like I can find almost any statistic that says, this is what the answer is. So, the old joke with statistics, you've got, lies, damn lies, and statistics. So trends are very similar. There's a lot of trends out there. And so let's kind of talk about that before we get too deep in this. So let's look at this. This is coming from Forbes. 10 fastest growing industries in the United States for 2018. So how many of you are working on these support activities for mining? Was that on your radar as one of the fastest growing? But how many of you, I hear startups always come up to me and say, we're in the fastest growing industry in the country. Well, I'd put this up there and go, oh, you're working in support activities for mining. What are you doing? And they're like, no, that's not what I'm doing. And they're going to go up here and they're going to go, oh, I'm doing a beverage thing. There we go. I recognize that one. So again, much like a statistics, doesn't every startup want to be working in one of the fastest growing industries in the U.S.? Of course they do. Okay, well, let's say that one didn't work for you. So I'm going to go find another statistic. Oh, well, we're going to go after the largest countries in the world that have the most GDP. Okay, no problem. There's the United States. There's your China, and so forth. Okay, that's a good choice. This one makes a little more sense. Okay. The problem is, I talk with startups and says, yeah, we're going to go after China. But you guys all live in the Silicon Valley. Who's in China? How do you know anything about China? No, but it's a huge market. Okay, so again, it's a trend. It's a good trend to follow, much like a statistic. Oh, now let's look at Deloitte. Now this one might make a little more sense to a lot of people in this room. Oh, cloud computing, flexible consumption, user-friendly tools. Oh, that makes sense. Now that looks like a real set of top 10. So again, all these things are important. And what I really want to do, you can look at these, and these are all real stats. These are all as of the latest thing I could find of who thinks what's going on. Okay? So I get people who want to call me all the time and say, hey, what are the top 10 areas I should be investing in? I could easily just sit there and say the same thing year after year. Oh, you should be in biotech, you should be in cloud computing, you should be in, these kind of things. Throw a couple of new ones in there. Oh, you should be in IoT, Internet of Things type stuff. Okay, so the idea of trends, they're important. So let's step back now that we've seen that trends and statistics are very similar. And let's start with the definition. A trend is a general direction in which something is developing or changing, right? So now, here's where people see all the time. They say, I'm going to go follow this trend. What really happens is almost everybody in a startup has an idea of what they're going to do. They already know what they're doing. They have a skill set. They have a competency. And I don't care what the trend says. They're going to build something that they know how to build, and they're going to do what they know how to do. So we're going to look at that from a little bit. So you've got short-term and long-term type of trends you want to look at. So what I hear a lot of people talking about when someone comes in with a startup is, hey, we had a great idea, and we're going to do this. And I'm going, wow, that really sounds like something that is going to happen in like 6 months. They said, oh, yeah, we're going to be all over it. Well, as an investor, I don't want something that's going to be big in 6 months. I want to be building for the thing that's going to be big in 3 years. So I want to be everything ready, so when that switch flips for that thing to be big, we're ready for it. If you're building a product that's ready to go and out the door in 6 months, then that's not an early stage or an investor type of a thing unless you're already talking to a VC and you're already at $100 million. So We're not looking for something with short term that's going to be done in months. We're looking for something that says, okay, there's some work to be done here, and in 3 years, this is going to blow the top off of something, we hope. Okay? So it's important to understand that. So what we really want to talking about here is understand where you are in the cycle of whatever type of product you're going to build and what it is. Don't get too wrapped up on trying to track all these trends and then pick a product or head a direction or do something because of that trend. You're already going to do what you do. So look more where you are on the cycle. You know, if you're building a good tool for a blacksmith, then you might want to recognize that that's an ending cycle. That's kind of, you know, out the door. So you got to know where you are there. So now let's look at trends, and let's think about them like a statistic a little. So you've got strategic trends. Those are generally driven by technology and science. Somebody will invent the internet. Somebody will invent a car. Science will come up with something. Those are strategic trends. They happen every 10 years. You know, they run in distinct cycles as well as most things. But they're strategic. Once that thing happens, then a lot of things fly off from that. So those are strategic. The next thing, you have vertical market trends. What they're really doing is they're taking a lot of these strategic trends and applying them. So medical, finance, automotive, business. So when you're looking at trends, you want to be looking at where you fit in some of these things. Now, the other one is processes. SaaS model, for example, you know, data, analytics, e-payments, automation of things. These are also methods or forms of trends. So when you're looking for trends that you want to see where they're going and how your company fits, what we really want to do, the bottom line, know what the trends are, but think practical application. Because you're creating something, and where does that something fit, and how does it fit, and how does it go in, and that trend takes you to where you want to be. So look at it more from that perspective rather than just, hey, here's a good trend. Okay? Build your solution based on your competency, like we said. I mean, it's amazing how many people I talk with, early entrepreneurs, that say, I understand that this, you know, there's going to be a huge growth in space travel. They know nothing about space travel. And it's like, well, that's nice. You know, you can go to school for 20 years and then go launch your startup. You know, what do you know, you know? So, you know, build it based on your competence. That's what you're going to do anyway, and that's what you're going to be good at, and that's what you're going to love to do. So anyway, what you really want to do is use the trends to navigate the course of where you want your idea to go and how it gets there. So you did get a little bit of trends here, but I didn't show up and just say, hey, here's the top 10 trends, go do something. I want, you know, because I think trends need to be understood a little bit better by a lot of entrepreneurs. Any questions on that? That was pretty quiet. Okay. So now let's get into startup model a little bit. So I'm going to start at the very foundation because I find that this valley has been around for so long that people lose sight of what the foundational concept. I can go to a band of angels. I can go to any of the incubators and accelerators. I can walk in and ask the question, explain to me the startup model. And you'd be amazed how these really sharp investors suddenly sound like a brand new entrepreneur. I got this answer. Wow, we built a so-and-so that kind of does this and that and that and this and that. And they're going, wow, it's not really that complicated. But we've been doing it for so long, we forget the basics. So we're going to start a little bit from the basics. So you can kind of look at three fundamental business models. You've got the traditional model. We all know that one. We've learned it. We've taught it. You know, we all know it. Work hard for 20 years, and you get a business. It's usually owner-controlled. You own 100% of it. It's your business, and it's usually debt-funded. That's what makes it traditional. The second significant business model is franchising model. You buy a business. You buy the business. You wear the hat. The logistics are in place. The branding's in place. You follow the checklist, and you'll probably be successful. Okay? Now, there's obviously hybrids of these in between, but these are fundamentals. You do it on your own or you buy it. Or we have the startup model, and it is distinctly different. And what happens for most entrepreneurs I work with, so I've helped launch over 200 startups in the last 4.5 to 5 years. And I've seen a lot of trends during that time. And what I see is entrepreneurs trying to employ a traditional business model to the startup model, and they can't understand why they're failing, because it sort of seems and feels the same when you're standing in the garage on day one. But it's not. This is driven by equity share and private investment, which changes the entire game. It's not just you in your garage anymore, okay? So let's look at this, startup model and innovation. I use that specifically because we think the startup model has to be used for innovation because that's what we do here in the Valley, and so therefore that's what we do. It is innovation, okay? So this is out of Lean Startup. How many folks out there read Lean Startup? All right. Looks a lot like a book I read back in about 1992, only it wasn't called Lean Startup, it was called Lean Electronics, but it's amazing, all the words were the same. Different anyway. So if you look at this, it talks about a startup as a human institution designed to deliver a new product or service. You'll notice in the definition, nowhere does it say an entrepreneur needs to start a company. What it says is it's a human institution to deliver or sell a product. What if I told you that one of the better business models, particularly if you're doing a tech-for-tech product, is not even go down the startup model, just go and get your product done, show that it works, then license it to somebody. You can do that in 18 months, walk away with $5 or $8 million, move on to the next project. Now, is that exciting as launching a $200 million or $1 billion company? Well, heck no. But you did it in 18 months and you're done. You move on down the road. And that's applying the startup model. It's the same thing. It's an acquisition model. But oh no, everybody wants to go out and go down 3 rounds of funding and all this kind of stuff and maybe think about an IPO down the road. And that's nice too. Nothing against that. Okay, so what makes this model unique? Really, it's an investor exit, which demands rapid growth because they're investors. I want my money tomorrow. I don't want it in 20 years, so they want rapid growth. And it's driven by acquisition. Greater than 90% of startups are acquisition. Many of them you'll never even hear of because they get bought real early in the days before they're famous because they have something that somebody here in the valley wants and they just buy them. And you might hear it in a little passing tech news somewhere along the line. But 90% of them, more than 90% are acquired. Very few go all the way to IPO and so forth. Now these are 90% of the ones that actually survive. Minor detail there, which, So this is an interesting thing because most time when you start a traditional business, you're going to build it, leave it to your kids, you're going to run it forever. You're not looking to start it and sell it off. And this is actually something that causes a lot of problems globally because many cultures, you don't build a business and sell it. That's considered equal to failure. So when I was in Saudi Arabia, nobody starts a business and sells it. You start a business and you die with it. You don't retire, you don't quit, you die with that business or you're a failure. So the concept of doing it and selling it doesn't work. But these things are uniquely different to this model, so you have to be working towards an acquisition strategy in most cases. Okay? So what are the challenges? Building a team. Do we have any entrepreneurs in here building a team right now? Isn't that fun? Okay? So what entrepreneurs go through on there is they want to have the best team possible because they know that's going to help them win. And they want the best team possible without paying them anything, which makes it hard to get the best team possible. They can be a little more demanding than that. But through this valley, we have enough resources that this valley can actually make that happen. And there's a lot of ways to do that. The other thing is equity. I've yet to work with a startup that fully understood the equity solution from a psychological and mental perspective versus logical. Everybody understands the logical of equity and all this stuff and moving around, but as soon as somebody comes in and says, okay, we're going to split this and we're going to separate the equity, the owners of it always go through, oh, I'm not going to do that. I can't do this. I can't give away my company. It's my baby. Anyway, they all do that. So it's a stressful part of being in a startup, but it's necessary. And then a quality ecosystem. Here we're fortunate to have a quality ecosystem around here. And so we can get a lot of things done here. Most of the world doesn't have that, a good quality ecosystem to get things done. And then on our side of the table, from investor side, is quality deal flow. And this valley is even worse than anywhere else in the world. If I go to Saudi Arabia, I can find the quality deal flow in a weekend. There's 7 of them. It's easy. I can find them fast. I come in this valley, oh my gosh, there is so much noise, I can't distinguish a good quality deal flow from just deal flow. So now, those are the challenges in this model, okay? So, we talked about innovation up here. The reality is it doesn't have to be innovation. We use innovation here because we do innovation. That's what we do in the valley. We've always been innovation. We started in defense, we've always been that. But all it is one of the 3 business models. If you choose to employ it, that's what we did in Saudi Arabia. We say you can organically drop a business right here, put an incubator right here. You can start businesses right here on the ground. They can become programmers. They can do whatever modern time does, and you can grow an industry with no resources. And if you apply that model, you just have to play it right. You have to know that 90% of your companies now would have to get acquired by some bigger company, which is why Saudi Telecom wanted to get involved. So this doesn't have to be tech. It can be anything you want it to be. It's just a model that gets applied. And as soon as you understand that, you can determine whether it's the right model to apply. And it is not the right model for everything. It is the most expensive money you're going to ever get. It comes with a whole lot of baggage and things that just going down and getting a loan and doing it on your own do not. So the question is, what model you want to apply? But don't start down the road and think, I'm going to apply a different model, but I'm going to do a startup thing. It won't work. Okay, so you got pathways. How do you do this? You can do it on your own. You can build your own network. Again, in the valley, that's doable. You can compensate with advisors, gray-haired people like me. I've spent a lot of time over the years being advisors for stuff. And that's a great model. You know, it works great. We've been doing it for 2,000 years. The second approach is through incubators, accelerators, innovation centers, whatever you want to call them. They're spinning up so much, they're all sorts of different names. Now, the advantages of this, you're plugged into an ecosystem by default. You're there. Everything you need is on site. However, they're not all created equal. When I first started working with companies like Plug and Play a long time ago, and some of these folks way back when, the models were a lot different. Back then, it was like $5,000 maybe and 3% equity. I'm seeing places now that are taking 10% equity, $20,000, $30,000, $40,000, $50,000. You don't have to pay it. You know, when you get funded and stuff, it comes later. But that's a lot of equity. You better be selecting the right incubator and accelerator when you go in there, and they're not all created equal. They all sell you this great idea that you're going to go in there and you're going to be successful. But they don't all have a good ecosystem. They don't all have a pull. A lot of times it's you having to push and do things. So there's a lot out there. But personally, if you go to my website, you'll see that it says right on there that we believe innovation will be driven by private investment through shared risk ecosystems and global teams. We believe this is the secret. I personally believe this will be the universities of the future. They won't go to school. They'll just go to an incubator with an idea, and they'll have the ecosystem around it and figure out how to generate that idea into something, and it'll come out. Now, fortunately, doctors and things like that will still go to universities, I hope. I don't want them to learn their product in an incubator. So we are talking business people, not CTOs necessarily. Okay? So there's still a fine line there. But I believe that most business people will go that way, and the statistics are already showing that. Now, you'll notice I've said a couple things. So let's take a look here. Silicon Valley. How many people have been working in the Valley? You've seen this poster around it. It's been around for 30 years. Everybody's got one in some form of nature. You know, oh, I used to work for them. Oh, I remember those guys. Yeah. All that kind of stuff. Anyway, I don't even know what year that one is, but everybody's seen one. However, the Silicon Valley is considered the benchmark for innovation ecosystem. Okay? Now let's take a look at an ecosystem. A community together with its environment functioning as a unit. Fair enough? Now if we kind of look back to lean, that's said as a startup human institution. Again, nowhere in here does it say company. Nowhere does it say, hey, make a startup company. It says get a community, get a human institution, get a bunch of people together, get an idea out the door and make it go somewhere. Okay? I will argue that the only reason we do a company is because if you're going to give somebody shares, you're going to have a C Corp. Oh, boom, check there, now you got to be a company. But nowhere in here does it say do that. But it makes the model work better. So I want to point that out a little bit here. So why is the Silicon Valley good at this? Because they learned to do three things. They learned how to incubate an idea, they learned how to fund it, and they learned how to commercialize it. Now, one of the things that made the Silicon Valley popular was because all those companies were across the street. So I came up with a great idea, the guy from across the street bought me. And then he became bigger, and then the bigger guy across the street from him bought him. Now, and because of this, Valley has created a really unique system around here that works amazingly well in a unique manner. But I would also love to, I also do talks on how it has now elevated itself to a level up here where it's in the stratosphere, and I don't think the Silicon Valley really knows what real is anymore. You know, I mean, I look at really, really good companies that are highly productive companies, and they get kicked to the side, and they can be highly profitable. They kick the side off because they're not going to be Facebook. They're not going to be Google. They're not going to be big. And it's this interesting marketplace. But they can do that. When you've got 400 companies at any given day in your lobby, you can be very selective. Anyway, so that's what they learned how to do that the rest of the world hasn't quite figured out how to do, and that's why they come here. So now I'm going to change this into a shared risk ecosystem, not an innovation ecosystem. So let's forget about innovation. Let's just think about a shared risk ecosystem, which is exactly what we have here. We just focus on innovation, okay? So think about this as shared risk. Why is it shared risk? Because everybody in this ecosystem shares the risk. If I had $1 for every time I've done free work for a startup, you know, we won't even go there. Anyway, so, but the idea is you're sharing this risk knowing that at some day in time that startup's going to be successful and, you know, all these great things will happen. And it does. I've read about it many times. But the reality, it does happen, and if you do it long enough, you'll be part of it as well. So it happens. But let's think about this. So this is a simple method of what we talk about when we say a shared risk ecosystem. I'm going to walk through this real quick. In our opinion, the center of that is right here. This is the innovation center of the incubator accelerator. This is where startups reside. I can walk in a door and talk to startups. They're right there. I can talk to them. I don't have to go find them. They're all right there. They're in one place, okay? Critical. The second most critical piece is the investor. If there's nobody to fund it, there's no fuel to make it happen. Okay, now from there, we're going to back up a little bit. So we need great people coming out of universities with great ideas, right? And they're going to go in here. Does anybody know what the purpose of an incubator is? Give me a couple ideas. What's the purpose of an incubator? Accelerator, go ahead. I like that. That's a good answer. Very good. She said to nurture an idea and bring it into existence. I'm going to break it down real simple. That is the solution to quality deal flow. That's all I want out of that incubator is quality deal flow. I want whatever comes out of here to be good and absolutely investable. Okay? And you're right. It's to do that. So there's a lot of stuff that happens in there that makes this thing happen. But in the simple terms, I just want quality deal flow out of the other end. If you do that, then they've done exactly what you said. You've provided them the resources to lift that company up and take an entrepreneur and make it a company. So now let's talk about that a little bit. So we have over here, so that got to have investors. But if you just have investors, you have the Middle East, you have Saudi Arabia, and you have Dubai. You have people investing in everything in the world and talking about it at dinner parties. They don't even know what they invest. What's the name of your company? Damn it, I don't remember. I don't know. But I have a company. Yeah, these guys, it's stupid. So they all fail. And that will fail here without that. So the next thing in line that's critically important are resources. These are the mentors and leaders that actually come in here and work for free or some form of money to elevate these companies up and make them successful. Without the leadership and mentors, you can't teach a 21-year-old how to do something they've never done before. And I would argue many of those you can't teach at all anyway. But anyway, that's a different topic for a different time. Anyway, so I own that age group, so far but anyway, so you've got to have these to be able to bring something inside this incubator to happen. The next thing you have to have are enablers. And those are things like R&D and manufacturing coders, people that actually do things that can get done for those. Now, this is where local businesses get to play in the startup ecosystem. You become the resources, mentors, and leaders, such as Abbott, Stringham, and Lynch. They are actually both. They are more of an enabler because ultimately they want to come out and do the work for you. They're not necessarily a consulting company. But they start on this form and may consult with you initially, but eventually they want to be the person that does your taxes, does your accounting, does your international yada, 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 evaluations, all these things. Now, the way this model works is people come in here, you do this, and you may have to share some risk initially to lock these people as in long-term contract. Now, I'll guarantee you up here, how many consultants or mentors and stuff we have in here? Any? Couple? Okay, 99.9% of the consultants that are doing this aren't necessarily doing it for, at least in this valley, for necessarily to blow out their consulting business. There's about 1% of them that are. The rest of them are looking for that hot startup that they can get on board and be the CEO, the CFO, or something like that that's going to take them to the promised land somewhere. And if you work with enough of those, you'll find those. Okay, so but that's true. I mean, that's just the way it is, and that's why they do it for free and work with them and do a variety of things. However, at some point in time, you have to make money. So the Valley has broken this in the fact that it's very difficult for these people to make money here because they expect you to do all this for free now because everybody's already had exits, and we haven't had an exit. What, you can't work for 2 years for free? No, I can't. Not with a $7,000 mortgage payment, I can't. No. Anyway, so this Valley's got some things, but if you work this right, it can work. But this is how the ecosystem works. If you have everything around to here, you can be absolutely successful. Everything from here around helps, and if you have them all, then you've got the Silicon Valley. You're there. It's, that's the way it works. Any questions on the ecosystem? I would say that understanding how to operate the ecosystem is the most important thing an entrepreneur can do to be successful. If you can't operate the ecosystem, then you're not applying the model right, which is building a community, and these kind of things. And so that's what makes this model work, because if not, you will find yourself in just a traditional business model where you're hiring people and you're creating a business, you're growing a business. If you're going to do that, just go and get a loan and grow your business. It's a lot cheaper. And a lot less demanding. Okay, that got some questions. Go ahead.
I know of limited number of these incubators and accelerators. Can you make some specific recommendations if you want to work?
Well, this is where they're at. So let me narrow that down a little. So the purple ones are a lot of them, all the way down to the little brown ones here that don't have very many, the little yellow ones. So just for reference, if you do all the sum total of, let's say, Europe, Europe, MENA kind of an area, you've got about maybe 10,000 incubators and accelerators. In the California region, we've got 15,000. So there's a couple of good ones in there. It's really hard because you need to look at it like an employer. What verticals do they specialize in? Where have they had successful verticals? What's successful come out of there before? What's their business model? How does it work for you? Like, for example, I can rattle them off. Most of them in the Valley here that have been around for a while, they're good. You can Boot Up Ventures, they're good. They've got a nice 2-year program. They'll take international companies. They'll set you up. They'll run you. There's a lot of good ones. As you work your way down, they get a little different. You know, everybody wants to get in line for 500 startups because they've been improving, you know. So the list goes on in Valley, but you really got to look at them because they're popping up all over the place every day now. That's a tough one to say. And this, you know, there's just too many of them. But those ones I just rattled off are all good. Yeah.
Approximately how many of those accelerators are in Silicon Valley?
I would say this whole area here is probably California altogether, and this is probably the Seattle, Vancouver region. So I'd say in this valley, there's probably, gosh, I don't even know anymore. There's got to be hundreds and hundreds and thousands of them here now. By now, they're just everywhere. Yeah, I mean, there are even all sorts of names. You know, you got Black Box, and I've been, there's one mansions. What's the one up in? Is it not Woodside? Where have I? Geez, I can't remember. It's just a mansion up in the middle of nowhere. It's gorgeous. You know, we were up there, and I did a talk there with Roger Royce and those guys years ago. But I mean, they're just everywhere now. You know, you find a mansion somewhere. Oh, it's an incubator. Anyway, I mean, the bottom line is, it's gone. It's gone mainstream. It is an accepted business model. Parents don't freak out now when their kids say, "I'm going to do a startup." You know, I remember, when our friends, our kids, I'm going to go to college. I'm going to do a startup. Oh, after college, you can do whatever you want. Anyway, so that's it there. So now, so that's kind of a fundamental basics of the business model and so forth. So let's see what we got for time here. Okay, we're good. We're about halfway through. You guys are pretty quiet. So that kind of sets up the foundation of what constitutes the startup business model, and it is uniquely different, and it gets applied differently. Okay, we covered a lot of territory. I've got like 3-hour class just on that section right there that we do. I teach a 6-hour class out at San Mateo College every once in a while. I haven't done that one for a while, but that's a college that got a nice view. Okay, so now we're going to talk about the startup model and kind of how it works. So we got the foundation of it. So let's kind of walk through that a little bit. So this is the life cycle. Remember the life cycle we had up earlier with early stage and, and the upstream launch? The life cycle doesn't change, but I kind of use a little bit of different terminology here, a little bit, just to keep it simple. Because we were talking about earlier, like we asked somebody, if somebody comes up to you and say, what's a seed company? What stage is an early stage company? Which one's first? In the life cycle, which is the earliest, a seed company or an early stage company? Oh, that's a tough one, isn't it? Well, it gets commingled, Some people call seed the beginning, and some people say seed is actually a round A. You're a seed round. You've already gone through the early stage. So it gets confusing. So I try to stay away from that. Every industry has terminology, so I try to speak in standard language that doesn't get too vertical. So let's start from there. So there's this basic model. You got the idea creation phase. That one's normally funded by friends and family. And it's often called things like bootstrapping. Okay? In this stage here, this is what has to happen. You have to be able to, you have to understand your customer. You have to have a plan. Doesn't mean you have to have an 85-page business plan, but you have to have a plan. You're not just winging it every morning when you get up after coffee. You have to know what it's going to cost to wing it every morning after coffee. And you have to be able to communicate that intelligence to somebody who cares. If you can't do that, then the rest of it fails. And you have to have an MVP or prototype, okay? So you're going to do all these things. In the early days, you used to get funded for this. You could go to Band of Angels, they'd fund you for that. Those days are so gone. So I'll give you an idea. So a lot of people might call this. So we went out and did all this. We had an MVP in a platform in 1998 at the beginning of the .com. This is my first startup. I was the only U.S. citizen in the startup. Everybody else was a tech visa. I was business side of the house, and we went out to get our first round of funding. Our very first round of funding, everything else was bootstrapped by the CEOs. We did one pitch and got funded. I was like, yes! 25 million. Those days are so gone. That's not going to happen anymore. That's why the .com only lasts about 5 years. But it was fun. Anyway, so normally now you're expected to show up with that. The bar has been set that you're expected to have done this. And so forth, okay? Now eventually during this here, you're going to run out of money. And you need to have a strategy, a plan, MVP, and prototype, right? And then you're going to probably go look for some angel money to get you kicked off. A couple $100,000, $500,000, $1 million, something like that. Now here's what you don't want to do, which I used to hear a lot from entrepreneurs, which I don't hear as much anymore, which means people must be going to go more meetups because they don't hear this all the time. I'll have them come and say, hey, I just need 35K. Well, what do you do for 35K except lose my 35K? You can't do anything for 35K. So if you're going to an investor, that's a friends and family, period. That's somebody you know. So when you're getting to this stage, you need to be having enough money to execute what your plan says you're going to do. Okay? And that's probably not 35K. Okay? It's probably somewhere between 200,000 to $1 million to $1.5 million in reality. Okay? Now, the purpose of that money has one purpose in life, and that is actually to get you to market entry to see if you actually have a product. I mean, at this point in time, you think you have one, and you found an angel who thinks you might have one too. So that's 2 out of 3. Okay, so now you're going to go to market. And so what they're really funding you to is to get through this. Because if you get through that successfully, then you will have the right product, the right price. You'll have validated that and so forth. And now you're going to go to VC funding and get the 10, 25, or whatever million you need to blow up. At the end of this, you're probably going to have some revenue. Maybe, maybe not. And that's everything he likes to say is you got revenue. But you may actually just have a 1.5 million users, which maybe just as attractive. But revenue is becoming more and more expected now because the .com went on users too, and that didn't work very well back then either. But anyway, so there's a measure base here. So that's what happens here. But here you have to have a validation and scale. Normally a product and revenue. Okay. After that, it can change a lot. Now you're going to go into growth. For most startups, they will probably be bought somewhere between here and here, the bulk of them. The ones we hear about won't be bought until out here or so forth, or they'll go and become some famous IPO. But a lot of them will actually get bought during this process, probably by these guys at some point in time early on, or some case like that. But assuming you go all through now you're going to go into Series A, Series B, Series C, D, however long you want to stay in this phase and can get money. I'm convinced that startups in this model have taken this model to the next step, and they've become companies that can raise funding and never actually achieve this end out here somewhere, but they're on round after round after round, and they say, well, it's a business. Okay, so eventually you move into what's traditionally institutional. Sometimes this is called institutional too, but you know the models change. But you got institutional, and you go up here and go up. These guys are just looking for growth and so forth and so on. I have a client right now that we kind of bypass this a little bit, which is really hard to do. We didn't really do any of this, and we're actually up here looking to somebody for 25 million without doing any of this funding. Now, that in itself has caused its problems. But anyway, that's kind of why I'm working right now. It's a challenge.
It is more common to bypass that angel funding, so make a prototype or a few customers and then go get VC funding. If
you have the money to do so, sure. I mean, but the bulk of entrepreneurs don't have the cash to skip this step. You know, it's just you know, if you do, great. But most they don't, which is why South Valley Angels and people like us exist. But this is the model. In most cases, you're going to go through this in some form or matter. You really can't skip it. And you know, like I work with musicians once in a while, or young students, and you know, they was, you know, hey, can I just skip the parts where I'm awesome? Okay, fine, let's just do that. Okay, so now let's talk about life cycle and where it's important. We're going to talk about the next stage up here. So we talked down here in a little more detail. I want to talk about this one because these are the two most important ones where you'll die. We talked about what you have to do here, and we talked about here. So you have to get funded, validate the product, validate the business model, and scale. And that's the biggie right there. Anybody can do anything on a small scale with a small server sitting on AWS. That next scale of going up can actually cause a lot of difficulties, particularly if you're in a hardware or some of these other environments, or a tech where you suddenly discover that what you thought was right is suddenly not right, and now you're back 7 months where you thought you were done. Okay, so these are what we have, the two parts. We just consider accelerating the company. So I'm going to back up here a little bit. So here we have a little bit we call incubate the idea, and then here we have accelerate the company as two different models. And if you kind of think of them in these modes and stay focused, you won't get scattered out. What I see with a lot of CEOs is they think of these two stages together all the time, and they're trying to work too much, too far down the road, and they're losing track of some of the stuff that's right now at the immediate, and losing track of, you know, in the engineering design world, you have what's called critical path. You know, and critical path is pretty simple. It's usually like only 3 or 4 things, but there's 800 things that are associated with that critical path for those things to happen. But they lose track of the 4 things on the critical path that makes them serious, and they go like that, and things happen. Okay. So now we have a sense of where things go in the cycle they work through. So now let's talk a little bit about some of the funding options. Okay, most of you probably know these things. We'll walk through them if there's any questions. Again, so we got the angel investor, an individual investor. Okay, that's a friends and family or somebody that you can actually find in these valleys. Those are just a net worth person. Most of them will invest between $5,000 and $50,000. And that's kind of how that works for them. Now, we have angel groups, Band of Angels, South Valley Angels, these kind of things. 50,000 to a million. A million's kind of high for a lot of them, but Band of Angels does that. If you're a woman-owned or majority business, Golden Seeds will do $1 million. A lot of them won't quite go that high. The most we've done is 750,000, and that was actually through a couple rounds kind of a thing, not at a one-time deal. But anyway, these operate different. Does anybody know the difference between an angel investor and a VC? Fundamentally? Ah, there you go. Yep, angel investors are investing their own money, so it's, they own it. That's their cash. VCs are spending somebody else's money. It's a job for them in most cases. They own they're the guy who runs that money. So it's a little different investment, and it's different what they're looking for. Here in the middle, I got the crowdfunding, and it's interesting because crowdfunding was all the rage a few years ago. And you'll notice that it's really quieted down a lot. They're still valid. What really happened is it just became mainstream, and now it's just another chunk in the path of something you can choose to do. It's no longer a big deal. So the last statistic I looked a couple years ago for doing crowdfunding. So let's see, which was it? Equity? Let's see, which one was it? I think it was Kickstarter. So Kickstarter, the stats for all the companies that had been successful on Kickstarter, the average raise for a company on Kickstarter was $824, I believe. So every time you read about a $1 or a $5 or a $10 million raise, a whole lot of zeros. But on the average company on Kickstarter was $824, I believe it was. Just for a number. Anyway, the big thing to keep in here, corporate ventures is one that's really getting kind of exciting right now, in my opinion. There's a lot of corporate ventures is really stepping out now. You used to have to know somebody and kind of know somebody how to get into Sony or how to get into Samsung or these kind of things. And now they've all got an arm. They've all got a venture arm now. And if you have a product that you think would be just awesome for Samsung or Apple or one of these tech companies, you can go to these corporate deals. Now, they operate a little differently. They'll give you smaller amounts. They usually give them as like a grant. But also, eventually, what they're going to do is if you keep getting the next round, eventually they'll be the ones that buy you. So it becomes a nice, quick, focused path. You won't get as much going a global path, but you'll continue to get funded easy, and you don't have to raise funds every time. And 3 or 4 or 5 years down the road, or what the case may be, you get bought anyway. Yeah.
Venture Report has an article a month ago talk about the legislation is allowing tokenizing the VC fund.
Yeah, I saw that. Yeah. I'm actually working with a blockchain company who's trying to do something that's kind of interesting.
So, what do you see that impact, and then how that we can deal with?
I think it's like anything else. It's another monetary. I like to simplify things. I spent my whole tech career working in things that were ungodly complicated. I've designed over 20 combat vehicles and jet fighter stuff, and I learned how to just simplify stuff. So I just look at that as another form of money, like a credit card or cash. If the credit card is a cash, it's a token. It's a bit, I look at that, and how is it going to change? It's probably change it the same way that credit cards did when they came in. Same way ATM cards did. Things will change, Things will go and move and different. I personally don't think it'll be any different. I just think it'll be a different method with a different, you can't run out and hold up somebody up with a gun for, they're going to steal your money on the internet now instead of by gunpoint. But I think monetization, it'll be just another form of money. That's my simple take on it. It's way more complicated than I'm engaged in. I have to ask these financial people here at ASL what that really means. So let's start off with, so if you're going to go do that, how do I talk to an investor? What do I need to have? Okay? You need to have documents. You can't do anything without paperwork. You have to have an executive summary, a pitch deck presentation, and a plan with financials. Okay? To get started. So that's the fundamental package to go out and do a job resume, or a business resume as you're calling it here. So now, let's answer that question. Let's talk about deal flow. So I'll start with my side of the table. So we're all sitting around in Morgan Hill having a coffee one morning and saying, we need to find an investment. Got to invest in something. Investors do that. Funny how that is. They're looking for investments. So you happen to wander by, what a coincidence. I'm in a startup. So here's my executive summary. Okay, so that's how it starts. Now, how do you do that? I would recommend, how many people go to meetups? Okay, how many of you go to the meetup, like the network mixers, the big events and so forth? Okay, so if you're looking for investors, go to events you know there will be investors. not big events where the investors are hiding in the crowd. Go to something that says there's an investor panel. Hey, that means there's probably going to be at least 4. Go to the panel, get their cards, and leave if that's all you have time for. Now you've got 4 cards. Now you can go back and research those investors and say, oh, this guy is invested in my spot. Okay, she's good. Okay. You know, what you don't want to do is don't stand there and sell your product to them in 30 seconds while you're standing across the table shaking their hand. And don't give them your card. Nothing personal, but I'm probably never going to call you. I go to these, I'm on these panels and I get 25 cards, and I'm not going to get up in the morning and call you. I'm sorry, nothing personal. You know, so go there and say, can I get your card? And we will give it to you. We're there to do that. If we weren't going to give you our card, we wouldn't be sitting on the panel. So ask for my card, I'll give you my card. Then send me an email, and I'll probably respond. It's really not complicated, but don't hit me with a you know, up there with 45, 45, 45, 45, it's hard to. Okay. And we're going to be awesome. Okay, so just ask for their card. So go to events where you know there's going to be investors, investor panels, investor talks, just those things, so you know they'll be there. And always get their card. You know, that's the simple method. You can participate in whatever that event's doing as well, but at minimum, just go in and get their card. And in the Valley, they have those at least 3 times a week. By the end of 2 months, you should have about 45 investor cards. How do you know? Oh, meetup. Some of the good meetups would be like Idea to IPO. They generally do them like every night. Events. Just look for the ones that say investor panel, not somebody who's going to talk about something. Or, you know, if it's a topic you want to listen to, that's great, but there probably won't be any investors there. So look for the ones that just say there's going to be investors there. And thins it out real quick. Yeah. Oh, go ahead. Nobody else is asking questions.
In your position, if someone has, you have an idea, and do you also contribute how everything is organized, or just?
As far as your company, you mean? Yes, we do, and it depends. You know, kind of. You know, the more you want, the more we organize. So yes, and normally we'll take some do it. We'll help you do that. Normally, you're not looking for an investor that just wants to give you money. That's friends and family. You want an investor that is going to come to the table and bring you something. So, for example, we're talking. When it comes down to work with right now, we're talking to an investor who's coming in a couple of weeks who actually has a large bottling company, a very famous bottling company, and they're interested because we're looking at making a beverage, and they want to invest in this. Well, they don't want to invest in us to give us money. They want to invest in us because they like our beverage, and they want to. And they've got all the logistics. They can flip that switch, and tomorrow morning our beverage is in every store and everywhere. You know, so that's what we were looking for. You're looking for something like that where there is absolutely a connection. Absolutely. Okay, so now we're looking for an investment. You give us an executive summary. That executive summary, normally I don't want your pitch deck. I don't have time for that. I can't take 30 pitch decks a week and read them. But I can read 30 executive summaries. You know, I can glance through that really quick, okay? And if you do a really good executive summary, so we're going to sit down, and when I look at an executive summary, what an investor is really looking for real quick is just, is this even a fit, and are you in my readiness? You know, if I'm a VC and you're an early stage entrepreneur, then right off the bat, we're not a fit. You know, so done. You know, so that's really what we're looking for. We're not looking for complexity this time. So I just need to understand from your executive summary, will you be a fit, and are you ready in this for me? Are you in the verticals I'm interested in, and these kind of things, okay? That's really what we're looking for. And if we all sit around the room and say, yeah, these guys looks like it, then you're going to start the screening process. We'll call you and say, hey, can you come in? And we're going to say, let's have them come in and deliver their message, okay? Let's invite them in, okay? Now, that can happen in a couple different ways. You're going to come in and pitch. In my group, if we ask you to come and pitch, you're going to pitch directly to an investor, and that's it. It's either go or no go. If you come into some of the larger groups, Band, Sandhill, Angels Forum, they have teams. The first time you go in and pitch, you're probably going to go in and pitch to their selection team. And then that selection team will say, hey, we like you. And then they'll help you get prepped for that monthly meeting. And then you go to the monthly meeting, okay? And that's how a lot of the bigger ones work, okay? Now, that is a big thing to know, because it can take 6 months to start with Band of Angels and get to a yes or a no. Because first off, I want to get in. Oh, we're booked this month. Okay, well, come talk to us next month. We just lost 30 days. So now you go talk to them. Yeah, we like what you're doing. Now we'll work for you, and we'll get you on the next month. Well, now you've lost 60 days. So now 90 days later, you're stepping in to do your pitch. Now, if they really like it and you have an inside person, like anything like a job, you can get squeezed through the process a lot quicker. Like anything, you know, getting a job from somebody who works there is easier than just knocking on the door and saying, I'm looking for a job. But these angel groups can take a long time, and people don't realize that, okay? But anyway, so now you're going to deliver your message, you come in and do the pitch, and now they're going to talk amongst themselves and go, hey, I like it, I want to meet the team. So now they're going to have you all come back, and this is what's called the deep dive. And you notice this one turned green. The reason that turned green is because you're probably pretty close to money. If you can get to a deep dive, all you have to do now is not screw up, in most cases, okay? Because they already like you. They just want to validate it. So this is really the beginning of the due diligence, okay? They're going to come in, talk to your team. They may spend days looking at your financials. They're yada, 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 yada. This could take a while, okay? Oh, now it turned green over here. The reason this turned green over here, this is the legal review and negotiation, because at this point in time as an investor, I'm going to turn on my accountants. So I'm probably going to spend $20,000, $30,000 in legal fees to do this next step. And I'm not going to do this next step unless I'm really sure we're going to do this next step. So now now it's costing me, up to this point it didn't cost me any money. But now it's going to cost me money. We're going to do negotiation, go through our due diligence, everybody's happy, and you get funded, right? So that's kind of how the process works to go through. And it's going to happen in that manner some way or another. Now let's talk about statistics. I get these all the time. We're going to talk about some interesting statistics. So let's start here on the left, right? I don't know if you can read that or not, but everybody always says, well, what does it take to get funded? Here's what it takes to get funded. I believe this was actually 2016. And of all the companies in the Silicon Valley that got funded in 2016, here were their stats. They contacted 58 investors. How many of you are in 40 yet? Pretty close? Okay, you're getting close then, you're almost there. You know what they say, every no is one step closer to a yes. Anyway, it's never funny when you're raising money. Anyway, out of that, they had 40 investor meetings. So 18 of them said no, right off the bat. So they had 40 meetings. They raised $1.3 million. So none of them asked for $35,000. So they raised $1.3 million. It took 12.5 weeks to close, not from the beginning of 58. When they started talking to somebody who says, I'm interested, it took 12.5 weeks to close. So expect 3 months to close your funding, okay? So now, how many people have gone to a bunch of startups who tell you have to have a 10-page pitch deck? Isn't that, it's got to be 10 pages, right? So the average pitch deck was 19.2 pages. Got them funded. So the page count is irrelevant. The message was what's important. So now, how many people have done pitch decks? How many of you have just spent so many hours you can't even fathom how many hours you spent on your pitch deck? So the average investor that invested, they spent 3 minutes and 44 seconds on that pitch deck. So I'm glad you guys spent all those months. Now the reality of it is, the reason they spent 3 minutes is because they already know what they know. They're going to go look at a couple things. Boom, boom, boom. Yeah, that looks good. I'm good with that. Boom. A couple things. Okay, that's what we're going to do. Now, so they spent 3.44 minutes. So what did they spend that valuable 3.5 minutes on? Almost 4 minutes. What did they spend it on? So how many people in here say you absolutely have to be solving a problem? Right? So they spent, that's how much they spent on the solution of the problem. It was the least important thing in the entire time they spent looking at pitch deck. Why? They already knew the solution of the problem. They're not going to spend any time on that. But if you have it wrong, they're probably not going to talk with you much longer either. So where do they spend their money? Oh, what are the odds? They spend it all on financials. Oh, gee, they're investors. They're talking about investing money. They're going to spend their time on the financials. So they spend their time on financials, the team, the competition. Why now? Those are the biggies. You know, starts winding down all of that ever popular problem and solution. The most important thing that everybody says, yeah. Okay, so now we've got some stats. So now let's talk about pitching in a pitch deck and what should be there. This is actually why I got into doing coaching and talks. When I got out of, I was doing a big contract. I had a contract that I was going to work on for 6 months, half-time. Turned out to be 2.5 years, 12 hours a day, 6 days a week. But they were paying me as a consultant with overtime, so that was sweet. And I was developing a truck that doesn't blow up to roadside bombs, and I saved thousands of lives over in Afghanistan and Iraq as our troops were using that, so it was a very, very good program. However, that program ended in 2009. None of my customers and clients wanted to hire me in 2009 or 10 or 11. I was like, well, this sucks. Anyway, you know, if everybody remembers, the economy wasn't doing real good when I came out of there. So anyway, I said, well, screw this. I'm just going to go back to startups. So in 2010, I focused back into startups 100%. And I did that because so I started going to some of these meetups when they were coming out and these things. And I was listening to these pitches. I go, these people are idiots. I learned absolutely nothing from this. And I said, I wouldn't say they were idiots, but their topics were just terrible back then. It was like, and some of it had valid, but most of the people who were doing the courses were marketing people. They weren't actually CEOs or operational people or people that launched a startup, but they were marketing people. And all the pitch decks were like 10 pages, no more than three bullets on a page, 32 font, and it's like, wow. And I was having those startups going, if I was an entrepreneur, I'd know absolutely no more when I walked out of there than I would have before. So I came in and started doing startups on how to, the reality of it. And so one of the things I don't talk about is how many pages you should have in your pitch deck. But there are formats and things to go in there. So let's start with the fundamentals of pitching. At the end of the day, your message must achieve its purpose. You have to get funded, you have to get your team, you have to get your partner, you have to make your sale, whatever it is. And so a lot of people like to blow it off. The message isn't really that important. It's absolutely critical. If I don't know what you're doing or how it works, or if you can't communicate it intelligently to me, then in a business environment, that's really, we've all worked in business where we have to sit down with somebody, with a vendor or something, and the person across the table knows absolutely nothing about what's going on here, and you're like, God, this is really hard. So, it's the same thing when you're trying to, your message has to be understood. It has to be understandable. It has to be clear and concise and compelling. And I'll have to admit, in the last 5 years, the quality of pitches in this valley have gone up dramatically. It used to be in the old days, if I asked an entrepreneur what they do, it was a 5-minute discussion of how they are the Twitter of Facebook that wraps this into a social environment and I was like, I have no idea what you're doing. People are getting really much better at this now. When I ask an entrepreneur today what it is, they're much clearer on what they actually do. So I'm glad to see that people are listening. But it has to be clear and concise, and that's where a lot of people fail. What you know it in your head, but if it's not coming out right, the people you're speaking to don't get it there. And the documents, everybody talks about I don't want to do documents, but the documents are actually what capture and organize your message. You can communicate that to somebody, okay? So now, what is your message, kind of what you're going through here? You have a vision and you see an opportunity. Again, if you're telling me how you're going to solve a problem in 3 months, then I'm probably not interested in investing in that. I want to see that you have a vision, and we agree with that. So I want to give you a good example that's popular. So when Tesla and Toyota partnered, they partnered because they both had the same vision. The future of the automobile is electric. Okay, they were on board with that. Well, then Tesla and Toyota divorced. They still stayed business partners, but divorced because Toyota changed their mind. They say now that the future of the automotive is hydrogen. So different visions. I'm not going to work towards an electric car anymore. I'm working toward hydrogen cars. So the vision becomes very important, and that's really what we're looking for is a vision that's somewhere and it makes sense and it's in line with what we believe is going to go on. Gets back to that trends thing, right? Okay? And opportunity is what investors invest in. They don't invest in ideas. They don't invest in teams. They invest in opportunities. If it's an opportunity, they'll invest. So you have to convince them that it's an opportunity worth investing in. Okay? And you have a solution and a plan to capture that opportunity they should invest in. Okay? So that's really all your message is. I have a vision, here's an opportunity, and here's how we capture that. Okay? Nice and simple. General guidelines. You sell your product to customers. You sell your business case to investors. So often we get a pitch deck that is nothing about how great their product is, and I don't know anything about their business case. I don't know anything about their go-to-market. I don't understand anything how they work in the competitive environment, how they're going to write. All I know is they have what they think is a great product. Okay? So you sell your product to customers, your business case. You define the opportunity and how you capture it. It has to be sincere and clear. And that if you're working at a strategic level, you probably have anywhere from 10 to 20 minutes to talk to an investor. In most cases, sometimes you get 30. You have to get to the point quickly and clearly and concisely and define that. You can't be all over the map with stuff. Or as smart as investors are and as much money as many of them have made, they ask some of the stupidest questions I've ever heard in my life. But we confuse them so much with some of the stuff we put in our slides and we present. Okay, so now I'm going to go through an example because I believe this is one of the biggest areas that startups fail is the problem of what they do. So how many people here have a startup that's, for example, a SaaS model or working using a SaaS model, some sort of cloud company? Okay, those are really big. So here's what I get from startups, and I call this a SaaS model syndrome. A startup will come to me and say, they'll come to me and say, oh, we're an amazing company. We're in this vertical market, legal, call it whatever. We are building a community of users and businesses that can operate and work together. We have tools that can allow them to do things they could never do before, and we can save them a ton of money. We eliminate their friction. Beautiful. That tells me you're a SaaS model. That's what SaaS models do. You don't get any benefit for that if you're a SaaS model. That's what I get for you being a SaaS model. So what we used to see a long time ago was that companies would come in and say, we've got an amazing UX UI. And in 2002, 2003, you got kudos for that because, wow, that's an amazing. In 2018, if you said, we've got an amazing UX UI. Well, I expect that. We expect that. You get no benefit for having an amazing UX UI. It's expected in today's model. Just like if you tell me I'm a SaaS model and I create community, capability, and cost. I just call those the 3 C's. Every single SaaS model will tell me every company that has a SaaS model will tell me that's their benefit. But that's not. That's the benefit of building a SaaS model. So what's really important now, then, great, you're a SaaS model. What's your benefit? What is the benefit for you? Okay? So me too. So I'm going to give you an example of a startup I worked with who worked in the hydroponics business, okay? And she had a vision that grow local and consume local. And I'm driving you through this because this is all the time we have for here, and this is getting towards the end. This starts from your vision. Her vision of agriculture, the future of agriculture, was to grow local, consume local, not ship it all over the world in the back of the trucks. Grow it, pick it, put it across the street, put it in the store and sell it, okay? Or put it into business. So she comes back and says, oh, you got to be into hydroponics. Well, why hydroponics? There's a lot of solutions. Oh, well, we can, so what we want to do is sit back and focus. You can't jump from a solution and right down to this and say, oh, here's my solution right here. You should be there. You have to help them walk to why that's there. So let's start with the problem you have to solve to grow local and consume local. Well, how do you grow in the winter? How do I grow a tomato in Minneapolis in January? Okay, that's a little challenging. Oh, it has to be in a controlled environment. Oh, fair enough. Okay, so the solution has to be something that has a controlled environment. Okay, fair enough. Oh, well, there's a lot of controlled environments, but we believe hydroponics is the way to go for certain reasons. So you can't just jump right here and say, yep, hydroponics is the answer. Whoa, 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 that's a big leap for a lot of people to make. So as a startup, walk them through these processes, okay? So, advantages of hydroponics, they're 24/7, 365, greater than not, all these efficiencies. That's why you want to be in hydroponics. Well, that's the only reason for being in hydroponics. I can get that from any hydroponic startup. None of these are benefits for you as a company. Those are benefits for being a hydroponic startup. That's what I get with hydroponics. Now, same with the SaaS model. I get this with every SaaS model I buy. That's why it's up there in the cloud, so we have access to all these things and can do all this stuff. So when you're looking at this, don't try to focus on what makes you unique. And that is huge. I see a lot of companies just struggle with that, and they end up coming out of there saying, well, I've got 32 like you in my lobby right now, and I'm going to invest in one of them. Why you? You hear that all the time. But the reason is because you didn't give them a why you explained to them why your technology, why your platform, or what there. Does that make sense? It's one of the biggest areas I see companies just not get the message out right. Now what you're saying, what has to be in it? This has to be in my opinion, again, my opinion. You have to have a visionary statement. You have to be looking down the road, not 6 months. You have to show that there's an opportunity, a problem that you solve. You have to explain that you understand the market where you fit. You have to understand that you have to explain to them you have a plan. You're not just winging it. It doesn't have to be a detail, but you got to have a strategic plan of how you get from here to, let's say, an exit or something. You have to talk about a team or how you're going to get that team, and you have to talk about financials. What order they're in does not matter. They can be in any order, but they have to be in there somewhere. I like this order because it's a nice story. I have a vision. Because of my vision, I see this opportunity. This is this is the problem to capturing that opportunity. Here's how we capture the strategic and tactical problems to do that. Here's how we fit in the market. And what I really don't care is what I'm not as important here is your product better than the next guy's, but how do you actually fit in the market? Not do you have 14 features and they only have 7 and your 14 are better. I really want to know strategically, how do you fit in the market based on your vision? So that's really important to tie those together. And this part here is really tied together. The plan has to tell me 3 things. How do you go to market in business? How does your product mature? And how do your operations go down the road? How do you get a team? Where do you open it up? How do you do those things? All you have to do is tell me those 3 things and kind of break it down from where you are today to where we're going to exit. No problem. You know, and then top of the team and the financial. So that's what has to be in your package. Yes, sir.
So about the team, you mentioned if you have a team or if you have a plan how to get the team. But my understanding is when you talk to VCs, you already...
Oh, you stated a lot. You said VCs. You have to have a team to talk to VC.
Okay, but prior to that, on the earlier stages, it's okay not to have a team at the moment.
Well, Well, nobody's born with a team. So unfortunately, in the life of a startup, there's a large chunk of time you don't have the team. And you can't fix that or change that in any certain manner. So
Let's say you know how to get the team if funding is in place.
that's always the case. I can always get the team when the funding's in place. So what really happens is you'll go and here's what happens in the real world. You've got 5 guys or gals that are going to be on your team. They've all committed to you. Hey, you get the money, I'm there. And they help you at night. They work a little bit as they can, but they've got a day job. You know, the wife or husband is saying, you got a day job. You know, so, but they're helping as much as they can, okay? And now they've been working for you for a year. It's all good. Boom, you get funded. So now the next morning you go and say, all right, we're all funded. You know, I got a promotion 2 weeks ago, and it's really looking pretty sweet right now. I'm probably not going to leave. Oh. So those are the kind of things you'll find on teams more often than not, is that team you thought you had won't necessarily be there a year from now when the funding comes. But that whole idea of how to do it is a tricky part. It's probably the hardest thing to raising a startup, is building a quality team. And I would say there's no science to it. A lot of it's luck and finding the right people and a lot of hard work. But if you get a good team, that'll beat everything else.
Is there any number, like how many team members is at that earliest stage, or it just depends?
Okay, let's take a look at teams. There's 4 key pieces you have to have for a team. You have to have a technical person who knows how to do what it is you're doing, right? That's one person. Maybe it's 2 or 3, but let's just say it's 1. Then you have to have a business person that knows how to actually run business in that business. Because I can guarantee you, the guy who knows how to build that product has no clue how to run a business. He will design until you're broke. Twice. Okay, so now you have to have a business person that actually knows how to count numbers and add 2 and 2 and not come up with an equation and those kind of things, okay? Then the third person you have to have in there is some sort of a subject matter expert of your area. So let's say you're in a regulated area or something. That's where advisors come through. And these become people like legal. You have to have somebody on your team that's legal that keeps you out of trouble, whether that's a tax person or whether that's a legal person, or that's just somebody that says, no, don't do that. You know, or I can help you do that better. Anyway, so you got to have those. And then the fourth one is the one that's probably the most difficult, and that's the CEO. The CEO is what I consider probably the most unfair position, because the CEO normally starts the company, and many times that CEO is really not the people we're looking for to run a company. So who are they looking for? I actually have a slide in my full deck, which is lightly entertaining, that I use here. I don't use it in Saudi Arabia, but I have a picture of Moses parting the sea with a Samsung t-shirt on, holding all these things, and it's kind of a cool picture. But the reality is that in particular VCs are looking for in a CEO. They want to look at that, and within 5 minutes they go, I'd follow that person. I would jump in the pit with that person, that person capture me. They're looking for that Moses that can capture you, compel you. 99% of us aren't that person. So how do we do that? And a lot of people can have that person and get funded and stuff. And it's not a fair piece of it. But the CEO, having the right CEO that a VC or investor says, I'd follow that person. I can respect that person. It makes all the difference in the world. And that's probably the hardest part.
You mean the founder and CEO are the same person, right?
Yes, they are.
But later on, when the company expands, you can hire another CEO.
Absolutely. You're talking about what the book says you can do, and I'm talking about the disadvantages of what happens in real life. You know, when you go and talk to an investor, and statistically, if you go and look at statistics now, does anybody know how tall the average CEO is in America? Over 6 foot. Over 6 feet tall. That's right, CEOs, America, over 6 feet tall. Why is that? Because we still have a reptilian brain. Whether we're men or women, we still believe in the stronger, the fittest, survival of the fittest, all those kind of things. And unfortunately, these things come into play when you're investing. Investing is not 100% logic. There is a lot of emotion on both sides of the table. And so the best you can do is put your best foot forward and do what you can do with what you have at the moment you have it. I have investors go, well, you know, today I don't have my full team. Well, I know, but we're here today. So what do you have today? Let's talk about today, and where are you going to go, and so forth. And if all that falls into place, you can get funded. But you can't change where you are today. If an investor calls you, hey, can you meet for lunch? You call and meet for lunch. So the team's hard, and so forth. That's probably the hardest thing of any startup is doing that. Yeah.
At this stage for you, what do you like to see in your financials?
Good one. Boom. Okay. 5 years by month. 5 years by month. Oh, and the slick deck. All I want to know here is you have a couple things. I got revenue coming in. I got expenses that go out, and I got something left over at some point in time. Now, what can really go handy in there is that can also be a place to separate your different type of customers. I'm going to have 1,000 of these, 400 of these, 50 of those. Because the reality is, if you're talking to an early stage investor, like an angel investor, we just want to see your growth. Because the reality is, if we think your growth pattern looks natural, then the finances are just math. So don't get too wrapped around what the actual numbers say. They're important, but if you're trying to tell me you're going to grow at 4,000% for the next 5 years, yeah, I'm not going to buy that and stuff. So, but yeah, this is just the basics. We'll come back.
And the rest of the stuff, don't even bother in your backup slide, wait for it.
Well, if they ask for it, what you want to do is, okay, one more thing, we're running out of time, we're actually behind, but the last thing to do, the purpose of your pitch deck is to get in and have the first date. Do the pitch. The purpose of the first date is to hopefully get a second date, right? Okay? So that's all you're trying to do. All you want to do is convince them you have a solid business case and get into the second date. So don't give them everything in the first date. They don't need anything. You give it to them. Now I don't need a second date. You know? So what you want to do is say, oh, I can send that pitch deck for you. Boom, send it to them, get some dialogue going. Get communication. You want to get that communications. That's what's going to carry you down the road in many cases. So you want to do, hey, so real quickly, if they say, hey, can you tell me about your finances? Boy, I don't have time for that. I only got 10 minutes. We can be here tomorrow at 1 o'clock and meet and go through finances in detail. Tell me about your products. Another good thing to do that. But yeah, you don't give it to them. And don't put too much on the slide. 99% of the time you guys put that up there, I can't even read it. We're sitting back there going, that's like 2 point font. I can't read that financial pitch deck there. All right, they're going to kick us out. No, the bouncers are at the door.